So, Linda, are we live now?
Yes, we are. Yep.
So the people are joining the session?
They are.
Yes.
They are.
Okay. That is fine. So, Bismillah Rahman Rahim, starting with the name of Almighty Allah. So, as the people are joining the session, we will wait for a minute so that the people can join the session and we will start in a minute. All right, so it is 7:03 p.m. So let's start the session. So it is Abdul Shakur from the Institute of Financial Accountant UK. So as we have the members and non-members in our session, so I would like to briefly introduce what IF is all about. Okay, so first of all, I warmly welcome you all on this wonderful session and a CPD session of Institute of Financial Accountant UK by Pakistan chapter. So we will be discussing the financial modeling and we will prepare a DCF model in this session, inshallah. Okay, so just a brief introduction. So what the Institute of Financial Accountant UK is all about, we have the recognition and collaboration with in global organizations, and we are present in global. We are present globally. We are the full member of Institute of Financial. We are full member of IFAC and recognized by HM Treasury UK. We have different MOUs and mutual recognitions agreement with different organizations, and we gave the designated letters to our members that are AFA UK and MIP Australia. And at this point in time, we are giving two memberships at the price of one. That is of Institute of Financial Accountant UK and Institute of Public Accountants Australia. All right. So as I said earlier, that we are present in different countries. So we are in UK, Europe, Middle East, and other countries. Okay. So the IFA in 2021 and beyond in Pakistan particularly. So the development of IFA presence in Pakistan, we have different MOUs with different organizations and universities in Pakistan. And recently in the previous week, we have signed an MOU with Superior University, Pakistan. And the number of members are growing in country, and we are building alliances with the different organizations and universities. And recently we have introduced a new educational program with the name of IFA Direct. And yes, we are providing value and support to the members in Pakistan. So what is differentiated in the IFA UK? So we have the in-country representative. Yes, I am the regional director for Institute of Financial Accountant UK in Pakistan, and we organize local CPD events on regular basis. After COVID, we are organizing CPD sessions online in the webinar format because due to the COVID-19. And before COVID, we were organizing CPD sessions in the face-to-face format, and soon in the new normal, we will be organizing the face-to-face sessions as well. So we have the magazine, the bi-monthly magazine that goes to the members, and we have the digital platform, and yes, there is the weekly e-newsletter that goes to the members. Yes, as I said earlier, that on regular basis we organize the CPD sessions in the face-to-face format and online and blended approach. And currently, due to the COVID, we are organizing face-to-face sessions. Okay, so our upcoming CPD and endorsed programs are we are holding internal audit planning, execution, and reporting session in April. We are starting certified financial modeler in the March, and a diploma in IFRS awarded by Institute of Financial Accounting UK. Our third batch will start in May 2021. Okay, yes, we have planned international conference, but due to COVID, this is not confirmed at this point in time that whether this will be possible in a physical format or not. Yes, but we have planned the international conference. Okay, so just a bit introduction and about today's session, we will be discussing a financial modeling, some techniques, and we will prepare a complete discounted cash flow model from scratch, and I will be presenting the session. This is my contact. So if we have any one who is the member of professional body, that is a member of the IFAC, for example, if there is anyone who is the member of ICAP, ICMAP, FIFA, ACC, and other professional bodies, or if there is someone who has completed the first 9 papers of the ACCA and the ICAP finalist, they can also join the Institute of Financial Accountant UK, provided that they have 3 years of relevant experience. So yes, if there is any query of the question, my contact details are there. You can contact me at any time. Okay. An important message for the members as well, that as this is regarding the renewal. So for the existing members, so if someone has not paid the annual renewal fee, the unfortunately the membership for 2021 will lapse midnight 31st March 2021. So you're requested to complete your annual return and pay your annual fee. Okay, this was all about IFA. Let's move toward our session. Okay, so I hope you can see my screen. Uh, Jonathan, can you see my screen? If you can confirm, please.
Absolutely, you can see that. Yeah.
Yes, thank you. Okay, this is a brief introduction about myself. Academically, I'm advanced financial modeler from Financial Modeling Institute, Canada. I'm certified public accountant and associate member of Institute of Financial Accountant UK, and I'm also the member of Institute of Public Accountants Australia. And I have the MPhil in Management Sciences. As well as the professional background is concerned, I am working as Chief Financial Officer in Bosch Home Appliances in Pakistan, and I'm representing Institute of Financial Accountant UK as a regional director in Pakistan. And I have been a lecturer in the University of Punjab. And yes, I'm the founder of Lexicon. And the Lexicon is an endorsed and accredited tuition and training provider of Institute of Financial Accountant UK. All right. At Lexicon, what we do is we provide educational programs, corporate trainings, and consultancy. Our vision is basically to become the market leader in the academic and professional programs. These are our affiliations. Yes, we are affiliated by Skills Development Council, Government of Pakistan, and we are endorsed by Institute of Financial Accountant UK. We are the approved tuition providers of Financial Modeling Institute Canada, and so on. These are our affiliations. Okay, what we are offering in collaboration with the Institute of Financial Accountant UK is we offer advanced diploma in accounting and finance, associate certified Islamic banker, certified financial modeler, certified CFO. We will be starting in upcoming months. This is the new course that we have got accredited by the IFA. And yes, we are the accredited tuition provider for diploma in IFRS UK, and we have successfully conducted the 2 batches for diploma in IFRS, and our third batch will start from May. And we also conduct trainings in analyzing and visualization with Power BI and Advanced Excel. So we also deal with corporate trainings, and some services regarding outsourcing, virtual CFO services, IFRS implementation, financial modeling, and Power BI implementation, along with Excel dashboard integration. Okay, as well as the upcoming trends are concerned, as I said earlier, that we will start with the Certified Financial Modeler program that will start from March 29, and I have a good news for the participants as well. And our new badge of IFA Diploma and IFRS will start from May 18, and we have a training in internal audit that will be on April 10th. Okay. So as a special offer for the attendees of this particular session is, for example, if someone wants to enroll in the Certified Financial Modeler program, there is a fee of 200 GBP for international participants and 120 for Pakistani participants. But for the attendees of this session, we will be offering the Certified Financial Modeling training and certification in 120 GBP. And for the training on internal audit, that is of 3 CPD hours, we will be offering for rupees 1000 only instead of for rupees 2500. Okay. A bit about certified financial modeler, because we will be starting on March 29th. So what we will be discussing in CFM is, we will discuss the advanced Excel functions, uh, including the what if analysis, goal, seek, scenario, manager, data table. And we will also discuss in detail the reporting and analysis through pivot table. We will prepare the profit and loss account and its analysis. We will also refresh some noun functions, some basic functions, and next we will discuss the financial modeling and the financial modeling best practices that are used internationally. Then we will prepare a complete financial model and how we can set up. Okay, we will prepare the schedules for the financial model. For example, the revenue and pricing, cost of sale, HR and payroll, and each and every schedule that is required to prepare a financial model. Then we will prepare a complete three-statement financial model, and we will discuss in detail the scenario management, how we can embed the scenarios, how we can create, and how the whole financial model is driven through the scenarios. And we will also discuss in detail the discounted cash flow model in certified financial modeler as well. Okay, these are the certifications. The completion certificate comes from the Institute of Financial Accountant UK, and there is another certification by Lexicon. Okay. All right. So what we will discuss in our today's session is discounted cash flow model and a financial modeling. We will be taking the questions at the end of the session. So if there is anyone who have a question, he or she can write in the chat window, and we will take all questions at the end of the session. Okay. Okay. So most importantly, the future of work would not be about college degrees, it will be about job skills. So this is from the freelancing survey that was conducted in US. So it says that in coming years, the future of work would not be about college degrees, it will be about job skills. So the thing is that each and every person, whether it is in accounting, finance, and every any other field, what he will require is a relevant skill set that is required by the industry and the market rather than the college degrees. As you have seen that the Google and the other giant has started inducting the professionals without college degrees, but with the relevant skill set. Okay. So there is a skill gap. What I think is that degrees only partially prepare the participant for the career, leaving out the hands-on experience employers demand and leaving you with a dilemma. As I said earlier, that in the current scenario, in the upcoming years, the most important thing that will be required by the industry and the employer would be the skill set. Okay, I'm not against the degrees, but the thing is that I'm focusing on the skill set that will be required by the industry and the market. Okay. So this is the reason that we regularly conduct the CPD sessions, and we mainly focus on the skill set so that our members and other professionals in the accounting and finance professional are updated. Okay, so this is a report, an extract from the report that was issued by the World Economic Forum. So they have mentioned the top 10 emerging skills and top 10 declining skills, and you can see that there will be 75 million job roles that will be on a declining phase, and there are 133 million job roles that will be in the emerging phase. And in the emerging phase, you can see that on the top of the list that there is data analyst and scientist, AI and machine learning, and so on. So in our today's session, we will be discussing the financial analysis. Okay, and you can see that there is the analyst job role is at the top of the list. There is another latest report by the World Economic Forum, and there are top 10 skills required of 2025 by 2025. And you can see again that the analytical thinking and innovation is at the top of the list again. Okay, so what we will be discussing is financial analysis in our today's session. All right, so this was the background. So what is the financial modeling basically? This is the one aspect of financial modeling, that the financial modeling is the process that can be used to forecast the financial performance and financial position of any organization based on historical data and some certain assumptions. So this is one aspect that the financial modeling, not financial model, but financial modeling is a process in which we forecast the financial position and performance of any organization based on historical data and certain assumptions. If that particular organization already exists, then we have the historical data. And if there is a startup, then we don't have historical data and we base our financial model on assumptions. Okay. So that was the financial modeling. Now, what is financial model basically? So financial model is the integration of technical and financial skills to create a user-friendly decision-making tool. So that was the financial modeling. That is a process. But what a financial model is, the financial model is a decision-making tool basically. On the basis of a financial model, we take certain decisions. Okay. The another thing that we can use, another definition that we can use for the financial model is this is a virtual representation of a country, of a company. Why this is a virtual representation? Because we prepare a financial model of a startup, of a company for the upcoming periods, whether these may be the 3 years, 5 years, 10 years, or 20 years. So because we are preparing the forecast of a company for the upcoming year, so this is why we call it virtual representation of a company, because we are preparing the forecast of a company for the upcoming periods. Okay. So we discuss what financial modeling is. We discuss what financial model is. Financial modeling is a process. Financial modeling is a process where we forecast. Financial model is a decision-making tool, okay, or a virtual representation of a company. So what we will be discussing in our today's session is discounted cash flow. So what discounted cash flow is? This is a basically a valuation method that is used to estimate the value of an investment based on its expected future cash flows. This is one aspect, that this is a valuation method that is used to value of an investment, that is used to value an investment based on the future cash flows. And the other thing is that the DCF analysis attempts to figure out the value of an investment today, because we have to decide whether we should go for this particular project or not. So discounted cash flow is a valuation method that is used to value an investment, value of an investment based on the future cash flows, and which that are discounted as at today. Okay. So The discounted cash flow is a valuation method that is used to value an investment based on the expected future outflows, inflows and outflows. And these cash flows are discounted as of today because we have to decide today whether we should go for this project or not. Okay, next. Purposes of the DCF model. So why we prepare a DCF model? So discounted cash flow model is prepared to value a business, project or investment, as I said earlier. This is also used to determine how much to pay for an acquisition. For example, you are preparing for an acquisition or the merger and you have to prepare a model and you have to determine what amount should you pay for the acquisition or the merger of any particular organization, and you will require a model. Then if you want to assess the impact of strategic initiative, for example, if you want to take an initiative and you have to assess the impact of this initiative, then you will require a financial model. And this is also used for the internal financial planning and analysis, and this is also used for the raising money. For example, we have to uh, uh, submit a financial model in bank to raise the money. Okay, so discounted cash flow model, as I said earlier, that we discount the future cash flows, and in cash flows we have the inflows and outflows. Okay, so what we do is we discount the future cash flows, including the inflows and outflow as of today. Okay, you can see that this is the first year, 2018, 19, 20, and onward, and DCF is the discounted value as of today. Okay, what we will be calculating in a case study that we will discuss shortly, and we will prepare a complete financial model from scratch. And what we will be calculating in that particular model is the net present value. What net present value is, we can break it down as net means the sum of all positive and negative cash flows. Okay, this is what net is meant by. The sum of all positive and negative flows are the values. Then the present value means discounted back to the time of the investment. Okay, so as we have to decide as of today, so discounted value means we have to discount each and every value as of today. Okay, so we have the NPV formula, that is net present value summation of cash flows minus initial investment. Okay, and discounted cash flows, basically, as you can see, that the CF over 1 plus I is rate of interest. And another function that another way that we can use to calculate the NPV is the accumulative inflow minus accumulative outflow. So these are the two functions or the formulas where we can calculate the NPV. We will calculate in we will discuss in detail as well in our financial model. Another thing that we will discuss is profitability index, how we can calculate the profitability index is present value of the future cash flows divided by the initial investment. In the NPV, we have subtracted initial investment, but in profitability index, what we will do is we will divide present value of the future cash flows by initial investment. Then we will calculate the internal rate of return. This is the very messy formula that you have seen, that you have used in your academic courses, but we will calculate but we will use a very simple function in the Excel. And this is also called a rate, where net present value is equals or get nearer to the zero. We will test this as well. Okay, we will also calculate the payback period. This is the initial investment or the original cost of the asset divided by the future cash inflows. Okay, these are the things that we will discuss in our financial model. Okay, so let's prepare a financial model from scratch. So what we will be preparing is uh, this is a case study. This is a case study, and this is a case study of a coffee shop. So this is ABC Coffee. This is a financial model for the years from 21 to 2030, and this is the data. that we will use in our financial model. As I said earlier, that this is a coffee shop and we have the data. For example, this is the initial investment that will be required to run this startup or the project. We will require certain equipments for this coffee shop. For example, the waffle iron, squeezer, blender, dishwasher, fridge freezer, ice maker, and so on, along with other equipments and landed building. So the initial investment that will be required for this particular project is 600,000. Okay, so this is the initial investment. Okay, so you may have a single figure for the initial investment, but I have break it down so that you can better understand it. Okay, so this is the initial investment, that is 600,000 as bifurcated by over here. Next, what other information we have is price per order for the first year would be rupees 100 US dollar per order. So per order price would be rupees, uh, price per order would be $100. Orders in the first year would be 1,000 in first year. This is not in dollar, but this is the quantity. Okay, so this is 1,000 orders. Then we're expecting that our sales will grow at the rate of 10% in the upcoming years. And we have the discount rate that is 10%, and there is a tax rate that is 10%, that is 30%. And we will prepare a model for the 10 years, and our base year is 2021. Okay, so these are the assumptions. This is the initial data. And for this particular project, we have the variable cost. So in variable cost, we have material cost per unit, selling expense per unit, and others variable cost per unit. Next, we have the fixed cost. And in fixed cost, we have the lease payments, we have administration, that is the fixed cost, and we have the other fixed cost as well. Okay. So what we will do here is we will prepare a complete financial model. Okay, and we will prepare an yearly cash flows including inflows and outflows, and we will calculate the NPV, profitability index, IRR, ROI, and payback period. And interestingly, we will also assign three different scenarios: worst case, base case, and best case, on the growth in sales respectively. For example, I said earlier that the sales growth would be 10%, but we will assign three scenarios that in the worst scenario, there will be a growth of 5%. In the base scenario, there will be a growth of 10%. And in the case of best scenario, there will be an increase in sale of with the rate of 20%. And in the selling price per unit respectively, in the worst case, our selling price will increase at the rate of 3%. And in the base case, our selling price per unit will increase with the rate of 5%. And in the best case, it will increase at the rate of 15%. Okay. So hint is that we will use the name ranges just to save the time. Okay, so I have mentioned over here that in the base case, growth in unit will be 10%. In best case, it will be 20%. In worst case, it will be 5%. And increase in price will be 5%. Then in best case, it will be 15%. In worst case, it will be 3%. Okay, so this is a case study. This is a complete detail about a project or an investment. What we will have to do is we have to create a financial model, and we have to calculate the NPV, profitability index, IRR, ROI, and payback period. Okay, so as I mentioned in the hints as well, that you can use the name ranges so that you can save the time. So this is a model. I have pre-formatted it for you just to save the time. And I have, first of all, I have mentioned the three scenarios: base case, best case, and the worst case. Okay. And we have the growth in units. We have base case, best case, and worst case, and we have increased in prices. Okay, Mr. Jonathan, are you here?
Yeah, I'm here, Abdul.
Okay, so is everything okay that my voice and the screen is okay?
It's
Are good?
absolutely fine. Yeah, I've gone back to the individual saying that all seems clear to me.
Okay, thank you very much. So that I can. Okay, all right. So we have the data, and just to reiterate over here that we have two options. One option is that, for example, some of you may know that we can change the name of a cell, and there are two options with me to change the name of a cell. For example, I want to change the name of this C5, that is $100, and you can see that here in the name box it is appearing C5. So this means that the name of the reference of this cell where I have entered the $100 is C5. So what if I want to change the name of this particular cell from C5 to any name that that is required by me? So my requirement is to change the name of this cell with the price per order for the first year. Okay, so there are two options. One option is that, for example, this is the cell that is C5, and I can change the name of this cell by entering the name, my required name, or in the name box. So this is the name box, okay, in Excel adjacent to the formula bar. So we can change the name. For example, this is price per order, okay, for the first year it may be. So this is one option. Okay, you can enter the name of any cell that is required by you. So as I have multiple cells that I require to change the name of them, so there is another option, and there is a shortcut key as well. I will not go for the manual change of name. What I will do is I will use the name ranges option. So to change the name of multiple cells in one go, what you have to do is you have to select the initial investment along with the numbers. Okay, so you have to select the name that you want to enter, okay, along with the figures. So what I will do is I will select the initial investment along with its figure, and I will select all the cells that are required to change the name. Okay, so here it is. And again, there are two options. One option is that you can click on the formula bar, and you have the name manager, and you have the group of defined names, and here you can create create the name ranges by create from selection. Okay, so here it is. You can click on the create from selection. Okay, so what I require is that I want to give name to this $100 that is in the left column of this figure. Okay, so what if what when you will click on the create from selection, because I've selected some cells, so you will click on the create from selection, a pop-up menu will appear, and there are four options. Top row, create names from the values in the top row, in the left column, bottom row, and the right column. So I want to create the names from left column. Okay, so the values appearing in C column, what I require is to give them name that is appearing in column B. Okay, so that is the left column from my figures. So one option is that you will go to the formula bar, just click on the create from selection. Okay, and there is already tick that is the left column, or you can click as well by your own. Otherwise, you can also click Control Shift F3. Okay, this is the shortcut key, Control Shift F3, and the same window will open, and you have to click OK simply. Okay, what you will see is that before entering the name ranges, you were seeing the C5 over here, but as we have created the name range, and you are seeing the name of this cell, that is C5, as price per unit. Okay, and the name of this cell, that is the order for the first year, as order for the first year. Okay, so I said there are three options. One option is that you have to enter the name of the cell in manual way, but that is not recommended in this case. And another thing is you have to just select the area. You have to select the names along with values, and you will go to the formula bar, and there is a defined names group, and you have to click on the create from selection. Okay, the second option. And the third option is you can click Control Shift F3. Okay, this is the shortcut key to create a named ranges. Okay, so as I've not selected the units, the cells, so it is not clicked over here, so you can click by yourself as well. Okay, so you can see the named ranges as well by entering the F3, Control F3. If you will press the Control F3, you will see the each and every named range that has been, each and every cell that has been named in the named ranges. Okay, so these are the cells that we have changed the name of. Okay, so we will use these name ranges in our model. Okay, so the first thing for to create a model is to change the name ranges or to set the name ranges. Okay, I've discussed the three different options with you. Okay, so let's move on the financial model. What we have to do first is we have to calculate the inflow. Okay, and inflow can be calculated by multiplying the price per order with the number of orders in a year. Okay, so what we have to do is we have to create a model for the 10 years. Okay, starting from 2021 to financial year 2030. And we have three scenarios. I have created the scenarios over here as base case, best case, and the worst case. And in the base case, there will be a growth in the units, that is the 10%. In best case, it will be 20%. In worst case, it will be 5%. And percentage increase in price in the best case, it in the case of base, the base case, it will be 5%. In best case, it will be 15%, and in worst case, it will be 3%. Okay, so first of all, we have to create the inflow or the revenue. We have to calculate the revenue. So to insert the values through name ranges, what you have to do is you have to just enter F3. Okay, and you will see each and every name over appearing over here in the window. And what I require is the price per order for the first year. As you can see in the data that we have the price per order for the first year, that is rupees 100, that is dollar 100, $100. And we have the orders for the first year, number of orders for the first year, that are 1000 for the first year. And we have assumed that in the next years there will be an increase in the number of units and in the price as well. Okay, so in the scenarios, in the above three scenarios, we will be using the one scenario at a time, whether it may be a base case, best case, or the worst case. So this means that in our financial model, these are the choices, and this will be the model driver. This will be the value that will drive our model. Okay, so out of these three models, we will choose one value that will drive the whole model. Okay, so we have to select that, we have to calculate that value first that will be used in our model. So here we will use the index function. So is equal to index. You may know the index function, otherwise I'm applying over here. You can see. So is equal to index. This is the array that are the choices, the array of choices, and what is required value, that is the raw number. Okay. So this is the raw number that I have, and that I have an output cell over here with me. If there will be a time, I will discuss the scenario switch as well. Okay, so here it is. It is 10%. Okay, I will use the same function for the percentage increase in price as well. That is the array. This is the array of choices. Then the raw number that is required, that is 1. Okay, so it is, that is 10%, then 5% that will drive the model. So here you can see that I have entered a scenario switch. I will discuss this scenario switch if the time allows me. Otherwise, I have entered the scenario switch. What I have to do is I have to enter the data just into the scenario switch. I will select this. Okay. I will select this particular switch, and I will go to the format control. And here I have the options: input range that will be displayed in this particular scenario switch, and an output cell link. Okay, so the input range that I want to display in this particular cell is this: the base case, best case, and worst case. What I require is that the base case, best case, or the worst case should be displayed in the scenario switch. Okay, so let me hit it again. Format control, here it is. And this is the input range that will be displayed in the cell. Then there is an output range, output link, output cell link that will gives us an output. And this output is the index number of that particular case, whether the base case is at which index number. Okay, so just you have to hit OK. And you can see that all the three scenarios are appearing over here in this scenario switch. And if you will select the base case, it is appearing 1 over here. What this 1 represent is that the index of base case is 1 in this particular array. Okay, and if you will select the best case, there is the number 2. What it represent is the best case is at number 2 in this particular array. And when you will select the worst case, there is 3, and this 3 represent that the worst case is at the number 3 in this particular array. Okay, so you can see again as well that whenever I am changing the case, the figures over here in these cells that will be used in the model are also changing. So it is base case, then we have the best case, then we have the worst case. And whenever I'm changing the case, and the correspondent values are changing accordingly. For example, if I'm selecting the base case, the values adjacent to the base case will be reflected over here, that will be used in our financial model. Okay, so this is the scenario management. Okay, so what is required to calculate the inflow or the revenue is that we require the price per order for the first year. So what you have to do is, as we have entered the name ranges in the data, so what you have to do is just click on the F3, and you will see a window where each and every named ranges will be appearing. And your requirement is price per order. Okay, for the first year. So here it is. Just I have just entered the P. I have just clicked on the P, and you will see each and every name with the P as it is in the alphabetical order. So just hit OK. So it is price per order for the first year. So price per order for the first year would be 100 US dollar, and the orders for the first year would be 1000 as I have entered earlier. So again hit F3, and here is the orders for the first year. I have entered just O. Okay, so hit O, and just select the orders for the first year. Hit enter. So here it is. Okay, so just to calculate the net sales or the inflow, you have to multiply the number of orders, the price per order, by the number of orders. So here it is. So the revenue for the first year would be 100,000, as we have multiplied the price per order with the orders for the first year. Okay, so In the data, in the assumption, we have assumed that in upcoming years there will be an increase in the price per order and in the orders itself, in the number of orders itself. So what it will be, so how we can calculate the increase in price or increase in the number of orders? So we can calculate the increase as is equal to previous year orders multiplied by incremented percentage. So what it is, so the previous year order multiplied by 1 plus the percentage. Okay, so as this is the growth in price, so this is the increase in price, that is 5%. Okay, so here it is. You can see that as our price will increase with the rate of 5% in the upcoming year, our price would be our price would be 105 US dollar. Okay, and that was $100 in the first year. Okay, what I will do is I will lock this P7 so that this percentage will remains fixed. Okay, so our order for the next year will also increase with a certain percentage, and we will calculate in the same way, that is the previous year orders multiplied by incremented percentage, that is 1 plus percentage that will be used in the model, and this is the growth in units, that is 10%. Okay, in the base case. All right, so we are seeing this 10% and 5% because we have selected the base case over here. So we will see that whenever we'll change the case, our whole model will change dynamically. All right, so I have to fix the O7 as well, because whenever I will copy this formula to the right side, this O7 should remain locked. Okay, so here it is, just select it and hit F4, or you can lock it with by entering the dollar sign. This formula, this is simple multiplication, it will remain same. Okay, so we were having the price per order for the first year or number of orders for the first year, and we have calculated the price for the second year, then the number of orders for the second year as well. So what you have to do is, for the calculation for the upcoming years, just select these three functions and the formulas, and select the upcoming years and just hit Control R. Control R is used to paste uh, a certain text or value to the right word. Okay, and Control D is used to paste certain amount to the downward. Okay, so what I have to do is, what I did over here is, I just entered the formulas in one function and I have copied it to the right word. Okay, so we have calculated the net sales or the inflow, that is 100,000 in year one, and then it is 1,000, 1,500, 500, so on. All right. So as we have calculated as we have to calculate the NPV and IRR, so what I will do is I will calculate the present value of inflow. So for the present value, we have a function that is the for the future value. What we do is 1 plus R is the rate of interest or the discount rate raised to the power number of years. So for the present value, what we will do is 1 divided by 1 plus rate of interest raised to the power n. This is the basic function in financial management. Okay, so we'll use the same function. So here it is, this is the value divided by 1 plus discount rate, and for the discount rate, what you have to do is you just have to hit F3 and hit D, and you will arrive at the discount rate. Hit OK. Okay, so here it is. So the present value at the rate of 10% as a discount rate, it is 90,909 instead of 100,000. Okay, so this is the present value. So what you have to do is you have to calculate the present value of each and every inflow in each and every year. Okay, so another requirement is the cumulative present value of inflow. So to calculate the cumulative present value of an inflow, what you have to do is the previous year present value of inflow plus current year, so that you can arrive at the cumulative, just like the cumulative depreciation. Okay, so arrive at the cumulative present value of the inflow, you will have to add the current year present value into the previous year, so that you can check the, you can calculate the cumulative. So as in the year 0 there is no outflow, so there is 0 plus current year, so it will remain same. Accumulative present value of the inflow in year 1 will remain same. Okay, and the present value in the year 2 and the cumulative present value of inflow in the year 2 and so onward, it will change accordingly. So what you have to do is just select these two calculations and copy these to the rightward with Control R. So here it is. Okay, so it has calculated dramatically. All right. So what we have calculated so far is, there is the net inflow or the net sale. Then we have calculated the present value of inflow. We have calculated the cumulative present value of the inflow as well. Then the next requirement is we have to calculate the outflow. Okay, and we have to calculate the present value of outflow as well, because we have to calculate the NPV. Okay, so in the outflow we have two things. One is the variable cost and another one is the fixed cost. And in the variable cost we have the material cost per unit. You just have to hit F3 so that you can enter the material cost. Just hit M. So here it is, the material cost per unit. Okay, hit enter. Then your requirement is selling expenses per unit. Hit F3, hit S, then S, and you will arrive at the selling expense per unit. Hit OK. Okay, then we have the others per unit. Per unit means it is variable. We have other fixed costs as well, but this is the others per unit. Hit F3 again, others, others for the first year, and we have others per unit. Remember that the per unit means this is variable cost. Okay, so here it is. These are the per unit cost, and we will calculate the total variable cost per unit. You have to just sum, and for the auto sum there is a shortcut key, that is alt is equal to. Okay, so you will calculate the total variable cost. So here it is. Okay, so this is the total variable cost per unit. To calculate the total variable cost, you have to multiply the per unit variable cost with the number of units or the number of orders. In this case, we have the number of orders. So here it is. Okay, this is the total variable cost. So what you have to do is just select all these cells and copy these to the right word. Okay, so here it is. This is the total variable cost for all 10 years. All right. So we have the fixed expenses as well. So in the fixed expenses, to enter the fixed expense, what you have to do is just hit F3. And in the fixed expense, you have the lease payment. So hit L for the lease payment, hit enter. For the administration, you have to click on the F3, and here are the administration, hit enter. And we also have the other fixed expense as well, hit O. So the simple others are the fixed expenses, hit enter. So here these are. So total fixed costs, as these are the fixed costs, and it will remain same for the all 10 years, and they have no link with the number of units or the number of orders. So we will sum all these fixed costs. Okay, the same way what we will do is we will select all these formulas in the function, and we will copy these to the right word. So we have calculated the total fixed cost as well, and we have calculated the total variable cost as well. Okay, so far we have calculated the total inflow, that is the total net sales. We have calculated the total variable cost. We have calculated the total fixed cost as well. And what we have to do now is we have to calculate the total outflow, then the present value of the outflow, so that we can calculate the NPV, and we have to calculate the cumulative present value of the outflow as well. And you are seeing the 600,000. This is the outflow basically. That is the initial investment. Okay. So you can see that in the data, we have the initial investment that is 600,000, and this is appearing in year zero. You can see that in the year zero there is no inflow, but there is an outflow, that is investment. And the present value of this 600,000 is also 600,000, because this is in year zero, and accumulative present value of outflow is also 600,000 in this year zero. So what we have to do is we have to calculate the total outflow first of all. So for total outflow, we will add the total variable cost and total fixed cost. So here it is. Just copy to the right side. We will calculate the present value with the same function that we have used already. We will use it as total outflow divided by 1 plus discount rate. So for discount rate, you will hit F3 again. So here is the discount rate. So here it is. So the present value of 32,500 is 29,545. Okay. So for the cumulative cash flow, what we will do is we will add the previous year outflow plus current year outflow. Okay. So this is the total accumulative present value of the outflow. So we'll copy these values, these function to the right side as well, so that we can calculate the present value of outflow for the each 10 years. And we have to calculate the cumulative present value of outflow as well. All right, I believe everything is clear over here, because I can't take the question during the session, so I am just assuming that you are understanding what I am doing, and yes, we will be taking the question at the end as well. All right. So yes, Jonathan, do you want to say something?
No, all I wanted to say, Abdul, was that the questions to date have been, will we share the recording afterwards? Will you share the slides and the templates?
So I believe yes, I will be more than happy to share the Excel file and the PPT file as well. And
Yeah.
I think the Linda will upload on the website and will share with the attendees as well.
Excellent. All right, that's where all the questions are coming from at the moment, Abdul. So no worries. Thank you.
Okay. So to calculate the net income, what we have to do is just subtract the outflow from the inflow. So this is the inflow minus outflow, total outflow, including the variable and fixed cost. So this is the net income. And for the tax, we have the tax rate in our data. So what we have to do is simply multiply the net income with the tax rate. So net income multiplied by tax rate. So for the tax rate, you don't have to give the reference, but you have to click F3 and select the tax rate. So here it is. Okay, so this is tax rate, and the tax for the year one is 20,000. One problem and one most important question that we come across from the student is that what if there is a loss in a particular year? So this formula, what it will do is this will calculate the negative tax value that is wrong. So what you can do is you can use the if function. So is equal to if this value is greater than 0, then this value should be multiplied by the tax rate. Okay, tax rate, otherwise there should be 0. Okay, so this is the function that can be used, so that if there is a loss in a particular year, so there should be 0 rather than a negative tax value. Okay, all right, so here it is. Then we have the net income after tax. So net income minus tax value. So here it is 47,250. And what we will do is we will copy this to the right word. Okay. So here it is. We have calculated the net income. We have calculated the tax. We have calculated the net income after tax as well. All right. Okay. So next important thing is we have to calculate the net cash flow, and we will use this as in helping cells as well. So net cash flow will be the inflow. Okay, this is the net inflow minus outflow, total outflow. So this is the net inflow in this year one. So in the net inflow, what we in the net cash flow, what I have did is I have just subtracted the total outflow from the total inflow, not the present value, not the cumulative value. All right. So here it is. Okay. So this is the net cash flow. In the year zero, we have the investment that is in negative, and in the coming years, we have the cash flow that is in positive. This means that we have greater inflow than the outflow. So next, our requirement is what we have to do is we have to calculate the net present value, profitability index, internal rate of return, and we have to calculate the payback period as well, and return on investment. Just for better understanding, for NPV, what we have to do, how we can calculate is we will use the NPV function minus initial investment. And for profitability index, it is pretty simple as well. We will use the NPV function minus divided by initial investment. In the NPV, what we do is we subtract the initial investment from NPV function, and in profitability index, we divide the initial investment. And in ROI, the function is accumulative discounted inflow minus accumulative discounted outflow divided by accumulative discounted inflow. Okay, we will discuss this in detail. Okay, so to calculate the NPV, what we will do is we will use a function that is equal to NPV rate. We have the discount rate, just hit F3, and here is the discount rate, comma. These are the values. These are the net cash flows. Okay, so these are the values. NPV minus initial investment. Hit F3. So initial investment. So here it is. It is it is 278. Okay, 278,000 around the world. We have the another option as well. So this is the initial investment. We can see that the initial investment not in zero, as I've subtracted over here. So this is the initial investment, NPV. Then we have the net cash flow minus initial investment. We can verify it. Just allow me a moment. Accumulated inflow minus accumulated outflow. So here it is. So what we have to do is present value. Okay. Okay, so this is our NPV, and next we have the profitability index. And in the profitability index, what we will do is we will, as I've said earlier, that in this case, in this function, what we did is we subtracted the initial investment, but in the profitability index, we will use the NPV. Then we have the discount rate. Okay, and we will give the reference of values. Here these are divided by the initial investment. So here it is, profitability index. This is 1.4. It should be greater than 1 so that you can accept a contract, so that you can accept a project. So here in this case it is 1.46. You can also calculate the internal rate of return. We can put the function over here that is equal to IRR. Then the values in IRR, you have to give the reference of negative value, that is the investment, and the positive inflows as well. So here it is. This is the internal rate of return, that is 17%. And for the payback period, what payback period is, what is meant by the payback period is that in how many years, in how many periods we will recover our investment value. So in this case, we will calculate our investment is 600,000, and what we will see is that in how many years we can recover this investment value. So what we will do is this investment plus, basically this is in negative because what I'm doing is this is the investment in negative, so that I'm using the positive sign. So this is the net cash flow. So in initial investment plus cash flow, net cash flow from the first year. So here it is. Okay, so I can copy these to the right word. So here these are. So you can see that in the year, so in the year 5, our value is in negative, and in the year 6, you can see that our value is in positive. So it means that we will take the 5 years to recover our initial investment. So our payback period in this particular scenario is 5 years. So how we can calculate is, we can calculate as if, count if, this is the range. Okay, so what we have to count is, we have to count the number of years when the value is lower than 0. So we have to calculate the years when the values are lower than 0. This means that when the values are in negative. Okay, so here these are. So in this case this is 5 years. So for the ROI, as I've mentioned over here, that we can calculate the ROI as a cumulative inflow, cumulative discounted inflow minus a cumulative discounted outflow, minus divided by a cumulative discounted outflow. Okay, so what this is calculated over here. Okay, so what we can do is, we can divide this net accumulated outflow divided by the cumulative outflow, that is here. Okay, here it is. So this is 86%, that is ROI. So what we have calculated over here, that we have calculated what is the NPV, what is the profitability index, internal rate of return, payback period, and ROI. So what we can see over here, that whenever we will change the case, for example, I'm changing the case from base case to best case, each and every figure is changing dramatically. Okay, so what if I'm changing the case from best case to the worst case, so each and every figure is changing automatically. So you can see that let it be in journal, not in the currency format. So this is in journal. So in the best case, in the base case, we have the NPV, that is 278,000. We have the profitability index, that is 146. This is in percentage. It should not be in percentage. This is in points. So let me reduce the decimals. So here these are. So our ROI in the base case is 86%, payback period is 5 years, and the internal rate of return is 17%. Profitability index is 1.5, and the NPV is 278. So in the best case, this NPV is increasing, and you can see that the impact on the inflow and the outflow as well in graph. So our profitability index is 4.5, IRR is 38%, and payback period is 4 years in the best case. So what if I change the case from best to worst? So in worst case, our payback period is 6 years, and our NPV is 15,000 and onward. Okay, and IRR is also decreasing. So this is how you can see, how you can present the financial model to your client or to your boss, how the things are changing. And you can see that in this particular case, each and everything is dynamic, and it is changing while we are changing the case. So here it is. So for example, this is the base case, best case, and the worst case. So whenever you will be selecting the base case, the things are changing. When you are selecting the best case, the things are changing, and the worst case, the things are changing automatically. Is it okay? Is it all right? That is fine. Okay. So this was on my agenda, that how you can create a complete discounted cash flow model from a scratch. And in this case, you have to uh, see that we have used the name ranges over here, and we have created a complete financial model from very scratch. And now you can calculate the NPV, profitability index, IRR, payback period, and ROI. Okay, so we will be sharing this file as well with you, along with the PowerPoint presentation. So let's move on to the question. If there are certain questions, we will take these questions as well in the question answer session. Nominally, in the year zero, we have only taken outflow of 600. However, given the business model example we have, it is possible that there may be also inflow and other outflow. How to proceed in such situation? So Noman, in this case, because this is a startup, and before in year zero, there is no inflow because we are starting the business in this particular year, and we have only investment as an outflow in that particular year. So, in the year of zero, in the starting year, there is only outflow because we are investing only. Okay, so as we will start our business from 1st January 2021, this is the reason that in year zero, that is 2020, there is no inflow. Okay, and there is $600 only. The reason is that there is an investment only, that is of $600. I hope this is clear. Okay, we have another question. Do we apply 1 year discount rate for the each year, for the second year, third year, and so on? Yes, this is the 1 year discount rate. Yes. So for example, if the discount rate change in the coming years, you can change the discount rate in the next years as well. Okay. But in my case, I have used the rate for the 1 year. Can you go over the IRR again? So here it is. In IRR, what you have to do is you have to click on is equal to IRR, and you have to give the reference of all positive and negative values. So here it is. Okay, so here it is. This is the IRR. Usama Shah, sir, how we determine discount factor? Discount factor is basically from the financial institutions. Normally, it is from the banks. For example, in Pakistan, this is determined by the State Bank of Pakistan. Okay, we have another question. Will you be sharing the recorded video? Recorded? Yes, we will be sharing. We have another question from Shkil Sab. Can you please repeat the line 35 again? Line 35 again. This is the present value. Line 35. So in 35, we have the inflow, we have the outflow. This is the initial investment. Okay. So present value of outflow in the year zero will remain same. We have the cumulative outflow. And this is the total outflow. That is the summation of variable cost and fixed cost. What we will do is we have to calculate the discount, the present value of this outflow. How we will calculate is equal to the total outflow divided by 1 plus discount rate. So here it is, the discount rate. Okay, so here it is, and you can copy this to the right one. All right. Thank you, Aziz Sir. Why you don't apply discount payback? why you don't apply discount payback. Discount on payback period, what I am assuming is that discount on payback, on discount, we are not using the discount on payback. The reason is that we have to just check that in how many periods or in how many years our investment value will be recovered. Okay, so this is the reason that we are not using the discount rate. Okay. Can you please explain the function if F3 and how it works? The function of F3, I think I missed that part, how the figures are put for F3, put for F3. So I believe this is the F3 function to paste the name ranges. So just to answer this question, so for example, I want to put the initial investment over here or the price per unit. So what I will do is just hit the F3 and the a window for, to paste the name ranges will appear. So you will select the required figure that you want in your sheet. So for example, this is the fixed cost or the initial investment. So for example, this is the material cost per unit. Hit OK. Here it is. And you can copy these to the right one. This is the F3 function. Okay. How can we get in touch with you for someone who is interested to participate in trainings? Here I'm entering my details. I will be sharing the details with you in the PPT as well. So here it is that my contact number is +92 303 4565764, or you can reach at abduls@ifa.org.uk. Okay. So Rana Abbas, thank you. What tax savings on depreciation? What about tax savings on depreciation? I have not used the depreciation over here in this case. Thank you, Rana Sab. Rana Sab saying that outstanding lecture. So thanks. We have engineer Ikra Hamid. How you calculate manual value of the NPV? We can calculate the manual NPV as the accumulative outflow, accumulative inflow minus the cumulative outflow. This will arrive you at the NPV. Okay. So Muhammad Asaf, for calculation of the PV, Y for second and the onward year formula of 1 plus is not. Just a moment. For the calculation of the present value, here is the present value. Where is the present value? Yes, let me check that if I have not used the raised to the power. Yes, this is not used over here, so this should be raised to the power. Thanks, Asaf Saab. This should be raised to the power the year. Okay, so I believe in the coming years I have not used the raised to the power as well. For example, this is the present value. It should be raised to the power number of periods. Okay, so it should be like this. Okay, so here it is. You can see that the another question from the participant, that how we can calculate the manual NPV. So our manual NPV is, you can calculate that the accumulative present value of the inflow, here it is, minus the cumulative present value of the cumulative outflow. So here it is. You can see that our both the NPVs via function and in a manual calculation, these are the same. And one other thing that I was saying, that IRR is the rate where the NPV is zero or nearer to the zero. So what we can see over here is, for example, let me change the discount rate Okay, so I was saying that IRR is the rate where NPV is zero or near to zero. So just to verify, what I will do is I will enter the 17.466 as a discount rate as I have used over here. So 17 point, what it is exactly? 17.466. 17.466. So just you can see that uh, this 17 discount tax rate, it is changed in the tax rate. So in the discount rate 17.466, and you can see that the net present value is 11.81. So for example, if I will enter two or three more points, so it will be nearer or the closer to the zero. Okay, so you can check by this way as well, that whether your NPV or the IRR is correct or not. Okay, so Asif Sab, thank you. Next we have, if discount rate change every single year. Yes, you can change the discount rate in the next year, and you have to put the discount rate in the each and every year below the year, so that you can change the discount rate. Sir, why you did not take the present value net cash flow? In net cash flow, yes, that is basically the net cash flow, not the present value. So this is the reason that I have calculated the present value by subtracting the outflow from the inflow. Please elaborate again the array section for the three scenarios. Okay, just a moment. Elaborate the array section. So here it is, I have used the three function. So I have the three options. These are the three choices: choice one, choice two, and choice three. And the requirement is I want to check, I want to extract one value that will be used in the financial model. So here it is. How we can calculate is, there are multiple options. We can use the choose function, we can use the index function, we can use the offset, we can use the index and match function. But what I'm using over here is the index function. Or now let me use another function, that is choose. So it is the choose. In the index number, I'm giving the reference, then the values, the value 1, value 2, value 3. So here it is. And you can use the choose function here as well. Index number, I'm giving the reference because I've not given the name to this cell. So then we have the three option: option 1, option 2, and option 3. So here it is. So these are the two options that can be used for the value that will be used in the function. Okay. Data is based market research and assumption. How can we reduce the variance between the assumption and the actual to minimum? Yes, you can reduce the variance between the assumption to the actual by a strong research, by spending the extra time on your assumptions, so that your assumption should be accurate and should be closer to the market data. We have the when we talk about PV, present value discounted for the number of the years annuity is cash flow is delayed. Should we not use power? Yes, you are right. This has been used. Please repeat profitability index and payback period as well. So what we'll do, profitability index in my in my PPT, I have already used, I've mentioned over here that the profitability index is NPV divided by the net investment. And the NPV, how we can calculate the NPV, this is the NPV function. I'm using the word NPV function, not NPV. So this is for just for reference and just for understanding. And NPV, by manual calculation of NPV, means the accumulative inflow, accumulative discounted inflow minus accumulative discounted outflow. Okay, so you calculate, to calculate the NPV, what you have to do is accumulative discounted inflow minus accumulated outflow. Okay, you will arrive at the NPV. For profitability index, you have to divide the NPV, that is the inflow discount accumulative present value of inflow minus accumulative present value of outflow, divided by the initial investment that you have made, that is 600,000 in our case. Okay, so you can see that this is the profitability index. So this is the NPV divided by initial investment. Okay, and it should be more than one in good cases. Okay, so the payback period means that in how many periods, in how many years we will recover our initial investment. And this is to calculate the payback period, I have used the count if function. And in count if, I have calculated the number of years that are lower than zero. Okay, and you can enter the years as well. So and years, so here it is. Okay, 5 years. So we'll be taking some more questions. Please elaborate the array section for the three scenarios I have elaborated. Will you please share the shortcut key you use during the process? Shortcut key, the main shortcut key that we use is Control Shift F3, then F3, and Control R, that was used mainly. Okay. So Kamal, you can use the lookup function to get exact payback period. Yes, lookup function can be used. Yes, you are right. Lookup function can be used to get the exact. Okay, for example, you can get in the points as well in that case. So okay, okay, so my name is Shehu Ibrahim. This is just to appreciate it. Thank you. Whether there is any chance of Excel being replaced, I think no. I think no, Excel will not be replaced as they are working. Very informative. Thank you. Where we can get hands-on experience in financial modeling, yes, you can enroll in our upcoming session where we will be discussing the complete financial modeling in detail, and you will also get the certificate from from Institute of Financial Accountant UK. Go for the CFM. Okay. Thank you. Please keep posting such session. Okay. Would you be sharing the Excel file? Yes. Thanks. Okay. Hopefully we will have session on XIR, MIRR2 and to 5 the differentiate between. Okay, in the coming years. Yes, we will discuss if we can hold different section on IRR and other functions. Revise the tax rate to 30. Revise the tax rate to 30. Okay, yes, that is fine as well. I have changed it to 10%, I believe. So let it be 30. In the data, we can move it to 30%. Okay, all right. Okay, thanks. Use the impact of financial model in the future with respect to data science. Yes, I believe the financial modeling is the most emerging skill set. Can you share the Excel file we will be sharing? Please explain the graphic table. Graphic table is basically showing uh, the inflows and the outflows, and you can see in the model, you can see that there is in the year zero, there is a negative graph, and in the coming year, you can see that the inflow is increasing and there is outflow as well in the gray shade. All right. Okay, with formula did use for the choose function, what formula did it, the function is choose is equal to choose. Would you be sharing Excel? Yes, we will be sharing the Excel. Can you please elaborate why we calculate the IRR, on what basis IRR is 17? Basically, the IRR is calculated on the base of this project, and it may vary according to the investment and according to the project to project basis. Okay, encounter several changes in price, say for the 2 months. Yes, in the next years you can in the next years you may change the prices. For example, I have changed to the 5%, 10%, and 15%. You may have other options as well. If net cash is negative, do we add negative tax rate? No, I have used the if function for the tax. How to fix the scenario key. How to fix the scenario key. I have not discussed the scenario switch. We'll discuss in the next session. The Google Sheet. Can this can be available on the Google Sheet? This can be used. Okay, thank you. Okay, so far we have taken all the possible questions that were possible. So once again, thank you very much, everyone, for your valuable time, for your valuable questions, and for your time that you have spared for this particular session. What I will request to Linda in the background is I will be sharing this Excel sheet along with my PowerPoint sheets, along with my PowerPoint presentation. Uh, you can share with the participants, and the participants who have attended the whole session will receive a certificate of participation from Institute of Financial Accounting UK. And I regret if there are some questions and that were not answered. So you can contact me at any time. I have shared my contact details with you. I will be more than happy to answer your questions. Okay, so thank you very much, everyone, again. So see you again in the next sessions. Allah Hafiz. Bye bye.